So why not just invest outside of super then? So this is something I've thought about because you get the flexibility then. So for myself, I have invested quite heavily in property, and that's something I'm using to look after my retirement. I've done that all outside of super though for reasons like I believe I'll actually need that before I get to 60.
Yeah.
Now, in this case here, is this just the same thing with the tax efficiency that makes super such an advantage? Is there any reason why, like again, why not just do it all outside of super?
And to add to your point there, Charlie, look, most business owners see super as an asset where they might lose money because the markets are going up and down, and you're seeing that in current recent times where the shares have dropped considerably. All super is the way I look at super is all super is a tax structure. You can have different type of assets in there, from shares, residential, commercial property, collectibles, cash, term deposit, all these assets that can be part of the SMSF. All it allows for is the income that's generated from super to be taxed at a much lower rate. And when you retire and take that income out of it in retirement years based on the current tax rules, it's all tax-free. So
let's go right there, because this is the thing again that highlighted to me this, because someone had said to me, and again, correct me, because this is where it's like, I'm not going to pretend I'm the expert on this topic. I'm told that if you were to, let's say you've got $1 million property, if you have that outside your super, right, when you come to that retirement age, you're going to get taxed on the rent that comes from that property at whatever the effective tax rate is. If that property was in your super though, so same property, bought at the same time, but it was inside your super, the way the tax works is very different, where you actually might be able to withdraw the rent as income tax-free from $1 million property.
Absolutely.
Is that true?
Look, absolutely. It is true, but you just got to have a look at the limits within those assets. So there's a $1.6 million cap that sits within that provision for allocated pension per person. And to further that, look, I'll give you an example of my clients, right? My clients, Joe and Lisa, who've sort of started their superannuation, and they've contributed, chipped away in super over the years. They've sort of built up this nice little retirement nest egg for $500,000 each. Now, they're driving an allocated pension income out of it at the rate of what are they invested in balanced fund, gives them an average earning of about 5% or 6%. So on $1 million, that's $60,000 tax-free. Now, for me to earn that $60,000 tax-free, my taxable income, give or take, it's got to be around $75,000. So to the point, yes, the assets that you sort of hold within the super fund or the SMSF, in retirement years, when you turn that into an allocated pension under current tax rules, yes, you can drive that income as a tax-free. And also, no CGT applied.
So when you sell the asset.
Yep.
So this is what I mean. These were the conversations I started to have. I'm like, ooh, crap. Like that's in retirement years, and I know this is in today's dollars, right? And noting that when inflation adjusted, we'll leave out of this conversation. But in today's money, like that's $15,000 to $18,000 difference per year in your pocket.
Correct.
So you would have to get a $78,000 return from a property to get the same amount of net return versus if it was in the super itself.
Correct.
And really important point there, that 1.7 million each. So for you and potentially your wife or partner or significant other, like that can really add up. So you could, if you have a spouse or a partner, that would give you 3.2 million that could be applied to this into your super.
Yeah.
Roughly. We'll call it 3 to be conservative here. So again, is like this really started to hit home for me, and why I started to take it more seriously, because I've got so many years of compounding here before we get to this point. So I used to just think it was all about getting money into super really cheaply. So let's look about reducing my tax today, and that's the benefit. But the other side of the conversation is that when you take, it's preservation age, is that's what it's called when you start taking.
Right. Yeah. So preservation age is the actual age when you can start to access. If you decide to retire at age 60, which for most people currently sits at about age 60. So it allows you to take, it allows you to start a pension.
Awesome. Now, I don't want to make it too densely technical. I'm hoping the bigger things come with it. But then someone said something to me after this, and it was all the same person, by the way, this person I'm referring to that convinced me on super. They also said one of the things is if you leave it too late to start contributing your super, what you're actually going to do is go over the amount you can actually contribute in this tax-effective way, and then it's not as good. And I was like, oh, what do you mean? Well, it's like if you waited till 55 and you wanted to put $1.7 million into your super in 1 year, right? That's not actually a tax effective way to do it. You want to do a little bit every year because that's where the benefit lies.
Yep.
Now, currently, I'm not even going to say what I currently think it is. What's the threshold on what someone can put into their super every year effectively right now? Like, what's that?
Yeah. So
I think it's like,
so you're absolutely right. Yeah, you've got to spread that out across your working life, and the reason you've got to do that is because you're collecting that tax effective savings over your working life of 25 or 30 years. And when you compound that, the biggest part also what you're missing out on is compounding over the years rather than just doing that lump sum level of contributions. So concessional contribution caps, there's roughly set about $27,500 for this current financial year, depending on what the budget rule comes out, obviously, and that might change things, which are generally taxed concessionally at 15% rather than marginal tax rate. Now, if you go over that contribution cap on concessional side, you may be taxed more, depending on how much you've exceeded. But for the non-concessional side, it's roughly around $110,000 for the current financial year.
so again, really important point to highlight there. Grant, you go. I've been mouthing off already.
I know I've got another question in here, but I do have.
But I do want to sort of
point.
Make a disclaimer there, guys, because if you want to make a claim of a tax deduction, it is important to be aware that your contributions have to be made before 30th of June to claim that as a tax deduction for the financial year. Plus, you need to notify your Superfund before claiming a tax deduction using a specific form. So there's strict time limits and some criteria do apply before you throw in that $27,500 to claim that full tax deduction.
Now, I've got fortunate enough to have equity in quite a few different businesses, and I've had to start thinking about this whole tax planning situation. And I was made aware that I could actually sell a large amount in a business, say for $1 million, where I get $1 million, and I can actually do a lump sum contribution into superannuation of up to about $500,000, which means instead of me needing to distribute it to myself as income within that financial year, I can actually distribute it back into superannuation.
Yeah.
First off, yay, nay. Second one is
that true?
Are there other things like this that business owners go, maybe there are some cool little strategies and tips and tricks, because I was going to get paying 50% tax on that, and now it would be like, 70%, give or take.
Well, there are small business CGT contribution caps that are available. Again, all depending on, there are strict criteria do apply, guys. There's a variety of different conditions that you do have to meet. But the good place to start there is to speak to your advisor or accountant before you start planning on that side. Because if you are to sell your business, and if your business do sell for $1.5 million, there are good tax strategies that are out there that would sort of allow you to not pay that 50% of tax on the when you sell the business.
And just to be clear, we're not asking for specific circumstantial stuff at all. The hope is someone listens to this and then they do reach out to someone like yourself, Ray, or their accountant and team or advisors they work with so they can do it. It's more about bringing awareness into the conversation around that.
Yeah.
Now, I do want to bring all these together though, because I think this is really interesting, because this is where I look at it and go, you can get money into super more effectively than you can get it into investments outside your super. So point one is that it's like, in my example I gave, about a 17 cent difference per dollar you move into super.
Yeah.
There's a cap on that though. You can only move currently about $27,000 a year into super, into that regime. And again, the criteria around that you've mentioned, Ray, definitely. And speak to someone who knows what you're doing.
Absolutely.
Not two idiots and one guy knows what he's doing on a podcast. Point three is that the returns you get in super as it's compounding are taxed differently versus outside.
Exactly.
So if I'm on a 47% tax rate in my personal life outside of super, my super returns are only being taxed at like 15%.
Exactly. Yeah. So the tax on earnings rate is,
right?
It's a massive, hence the reason I love super, because it is nothing but a tax structure.
Hey, fellow business owner, if this topic and value-packed short video has resonated with you at all, and you want to dive deeper into being a full stack business owner, check out the full episode by clicking the link on your screen or in the description right now.